November 13th, 1998. TheGlobe.com goes public. The company has never made a profit. Revenue for the year, $2.7 million. Losses, $11.5 million. On day one of trading, the stock opens at $9 and closes at $63.50. A 606% gain. In a single day, TheGlobe.com achieves a market value of $842 million. What did TheGlobe.com sell? Nothing, really. They ran a website where people could create personal pages and chat. They had 1.2 million registered users. No clear path to monetization. No proprietary technology, just traffic. But in 1998, traffic was enough, because the internet had created a new economic logic. Revenue didn't matter. Profits didn't matter. What mattered was eyeballs. Get enough people looking at your site, and someone would figure out how to make money from them later. This is the story of how attention became more valuable than revenue, how page views replaced profit margins as the measure of success, and how an entire generation of investors convinced themselves that if you could gather enough eyeballs, earnings would inevitably follow. By the end, you'll understand exactly how metrics replaced business models, how monetization became a problem to solve later, and why this logic created companies worth billions that had never considered how to actually make money. For most of business history, success had clear metrics: revenue growth, profit margins, return on investment, cash flow. These numbers told you if a business worked. If you ran a magazine in 1990, advertisers asked two questions. How many subscribers do you have? And what do you charge per 1,000 readers for ad space? That's CPM, cost per milla. It had been the standard advertising metric for 50 years. A magazine with 500,000 subscribers might charge $50,000 for a full-page ad. That's $100 per 1,000 readers. Simple math. The magazine knew exactly how much revenue each reader generated. They knew their costs. They knew their profit per subscriber. This model assumed something fundamental. The audience you gathered translated directly into revenue. Circulation numbers mattered because advertisers paid for access to those readers. Then the internet arrived, and suddenly, gathering an audience became essentially free. Anyone could put up a website. Server costs were negligible. You could reach millions without printing presses, distribution networks, or postal delivery. This created a fascinating puzzle. If gathering an audience was free, and that audience was huge, surely it had to be worth something. The question was, how much? And the answer markets gave was, almost anything. The shift started with a reasonable observation. Internet traffic could be measured with unprecedented precision. Every click, every page view, every minute spent on site. Data traditional media could never capture. Instead of rough circulation estimates, internet companies could tell you exactly how many unique visitors they had, how many page views they generated, how long users stayed, what they clicked on. The granularity was revolutionary. In 1997, GeoCities reported 38 million unique visitors per month. That made it the 5th most visited site on the internet. The company was losing money, about $7 million per year. But Yahoo looked at those 38 million visitors and saw pure potential. Yahoo's calculation went like this. GeoCities has 38 million monthly visitors, generating 400 million page views. If we can monetize even $100 per user per year, that's 38 million revenue. At a 20% profit margin, that's 7.6 million in profit. At a price-to-earnings ratio of 50, that justifies a $380 million valuation. In January 1999, Yahoo acquired GeoCities for $3.6 billion. 10 times the back-of-envelope valuation. The premium wasn't for current performance. It was for the belief that those eyeballs were about to become vastly more valuable. GeoCities' founder explained the vision simply. People were spending hours creating personal pages, uploading photos, writing about their lives. That engagement had to be worth something. The business model would follow the audience. This phrase became the mantra of the era. Build audience first, monetize later. It will explain every decision that follows. Once eyeballs became currency, a race began. Every major company wanted to become a portal, the entry point to the internet, where users started their browsing sessions. By 1999, the portal wars involved dozens of players. Yahoo, Excite, Lycos, AltaVista, AOL, even traditional media companies joined. Disney launched Go.com. NBC created NBCI. Each believed controlling the homepage meant controlling internet traffic. Let's examine what this meant in practice. Excite Home, created by merging Excite Portal with cable internet provider Oppo, US Home, reached 12 million users by 2000. The company was losing $600 million per year on $1 billion in revenue. But analysts valued it at $35 billion at its peak. The logic: 12 million users spending an average of 45 minutes per day on Excite represented 540 million user minutes daily. If they could monetize just 1 cent per user minute through advertising, that's $5.4 million per day, or $2 billion annually. That calculation assumed something impossible. Users wouldn't tolerate enough advertising to generate 1 cent per minute. Most internet ads in 2000 paid $1.4 per 1,000 impressions. To hit 1 cent per user minute, you'd need to show users 20 ads per hour. The math didn't work. Unable to monetize traffic directly, portals pursued a different strategy: acquire more eyeballs. Excite spent $780 million acquiring smaller sites. The theory was simple: more traffic meant more leverage to charge advertisers. At Go.com, Disney invested $1 billion trying to compete. They hired 1,500 employees, bought InfoSeek for $465 million, generated 20 million monthly visitors, and discovered that Disney.com visitors, people looking for Mickey Mouse, didn't become Go.com users looking for general web search. The portal strategy assumed traffic was fungible. Get people to your site for any reason, and you could monetize them. This assumption contained a fatal flaw. If gathering eyeballs was the goal, some companies took the concept to its logical extreme. They gave away their core product for free just to acquire users. FreeInternet.com launched in 1998 with a simple pitch: we'll give you free internet access. No monthly fee. You just watch ads while you browse. Within weeks, they had 500,000 registered users. Standard internet access in 1998 cost $20 per month. FreeInternet.com was paying telecom companies $15 per user for dial-up access. They were losing $15 per user per month before any operating costs. Their business model relied on advertising. Each user had to generate more than $15 per month in ad revenue for the company to break even. The company projected they could show users $25 or $30 worth of advertising monthly through banner ads and sponsored content. Reality was different. Users hated the ad-heavy interface. Average session length was 12 minutes, not the 2 hours the model required. Ad rates were $5 per 1,000 impressions, not the $20 they'd projected. The math never worked. FreeInternet.com wasn't alone. FreePC offered free computers in exchange for advertising exposure. FreeDrive offered free cars wrapped in ads. Each followed the same logic: acquire users at a loss, monetize through advertising later. At its peak, FreeInternet.com had 2.1 million users and a market cap of $900 million. The company was burning $8 million per month. In September 2000, it ran out of capital and shut down. Total lifespan: 18 months. The failure revealed something crucial about the eyeball economy. Attention without intent is worthless. Users who came for free internet access didn't click on ads or buy products. They were there for the subsidy, not the service. By late 1999, cracks appeared in the eyeball logic. Companies had successfully gathered millions of users. converting those users into revenue proved far harder than anyone expected. The problem was simple arithmetic. In 2000, the average website earned about $5 per 1,000 page views from advertising. A site with 100 million monthly page views generated $500,000 in monthly revenue, or $6 million annually. That same site, if it had 10 million unique visitors, might be valued at $500 million based on eyeball metrics. To justify that valuation with a price-to-sales ratio of 10, it needed $50 million in annual revenue. That required 830 million monthly page views, an increase of 730 million. Getting from 100 million to 830 million page views meant 8 times as many users, or existing users, spending 8 times as long on site. Neither was realistic. User growth was slowing. Time per session was declining as more sites competed for attention. TheGlobe.com demonstrated the problem perfectly. By mid-1999, they had 3.5 million registered users. Monthly ad revenue, $400,000. Annual run rate, $4.8 million. Market cap, still $500 million. The gap between valuation and revenue was 100 to 1. Even worse, internet advertising rates were falling. In 1998, banner ads sold for $20 to $50 per 1,000 impressions. By 2000, rates had dropped to $3 to $100. More inventory, fewer advertisers, and declining click-through rates all pushed prices down. Companies tried everything: pop-up ads, interstitials, email marketing. Each innovation annoyed users more and generated less revenue than the last. The fundamental problem remained. People came to the internet for content, not advertising. The eyeball economy had created a paradox. The more successful a site was at gathering users, the harder it became to monetize them without driving them away. The collapse came suddenly, but predictably. When markets realized eyeballs couldn't convert to earnings, valuations evaporated. In January 2000, ExcityHome peaked at $35 billion. By December 2001, it filed for bankruptcy. GeoCities, acquired for $3.6 billion in 1999, was shut down by Yahoo in 2009 after years of declining use. TheGlobe.com, worth $842 million in 1998, traded for 7 cents per share by 2001. The trigger was simple. Companies needed to raise more capital to keep operating. But investors demanded proof that eyeballs could generate profit. Most couldn't provide it. Without new capital, the cash burn couldn't continue. Go.com had 20 million monthly visitors when Disney shut it down in January 2001. The site was generating $20 million in annual advertising revenue. Operating costs, $160 million annually. Disney had spent $1.4 billion. They couldn't justify spending more. Between 2000 and 2002, portal and content companies laid off 185,000 employees. Investors lost $1.2 trillion in market value. Hundreds of companies that had raised billions disappeared completely. The collapse wasn't about bad execution. It was about flawed logic. No amount of traffic could generate enough advertising revenue to justify billion-dollar valuations when ad rates were $5 per 1,000 impressions. Here's what makes the eyeball era fascinating. The core insight wasn't entirely wrong. Attention does have value. Building an audience first can work, but only under specific conditions that most companies didn't meet. Google figured out the formula. They built an audience through search. Then they monetized it through intent-based advertising. People searching for buy shoes saw shoe ads. Click-through rates were 5 to 10%, not 0.5%. Advertisers paid $5 per click, not $5 per 1,000 impressions. The difference was intent. Google's traffic had commercial purpose. Portal traffic didn't. People came to Yahoo to check email or read news, not to shop. The eyeballs were real, but they weren't valuable. The eyeball era taught markets a hard lesson about the difference between attention and value. You can gather millions of users. You can generate billions of page views. But if those users aren't there to buy something, the business doesn't work. This matters because the same logic reappeared. Twitter spent years building an audience before figuring out monetization. Snapchat gathered 200 million users before developing a sustainable business model. The strategy can work, but only if you eventually find high-value monetization. For investors in 1999, the distinction seemed unnecessary. Eyeballs were eyeballs. Traffic was traffic. Build it and they will pay. Only later did the difference between engagement and commerce become obvious. Markets don't value attention. They value the present value of all future revenue that attention can generate. Eyeballs were worth billions because smart people believed advertising rates would rise and users would tolerate more ads. Neither happened. The era of eyeballs over earnings lasted about 5 years. Long enough to create and destroy trillions in value. Long enough to prove that attention without monetization is just an expensive hobby. And long enough that we're still learning the same lessons today.